All right, guys, that's it for the news here today. A couple earning stocks. Let's run into our next segment if we can here, Greg. And I've been having fun with this one the last month. Let's kind of set it up a little bit. Greg is an old money investor. He has that mindset about, dividends and food companies and revenue, and he looks for specific things. And fundamentals are a big part of the way Greg approaches the market. And so each and every week on Thursdays for the last month or so, Greg has brought three different stock ideas, which are fundamental ideas, more longer term thinking. And he kind of presents them, and then the coaches get to decide which one they think is the best buy, which one they think is the best hold, and which one they would dump outright in a little game that we play. Greg, you're up, man. What do you got today?
All right, Ty, can you bring up XLV for me, please? So, healthcare space, kids. This is where we're playing this is the sandbox we're playing in today. What I like about this sector, held up pretty well, even with the bit of weakness we've seen recently. Held up pretty solid. Still looking for a breakout move here. Big green candle today. So I went to the health space and I started digging deep to see what kind of companies we could have there. So I've got three plays today. I'll run down the numbers. You guys can decide, buy one, dump one, hold one. And let's see what we got here. I use the same metrics that I did last week. I brought in some sales growth component and all the typical metrics there, just to kind of add a little bit to it. So first up, we got J&J. Johnson & Johnson. So technical read, at a breakout point, had a decent recovery. Earnings has gone by, so that's not an issue. Not necessarily your swing trading stock, but that's not really what we're doing here. What we're looking for is fundamentals, and if there is some growth potential in there, that's key as well. So the numbers stack up like this. Obviously, $171 stock. Their dividend yield is around 2.5%. They paid consecutive dividend increases for 58 years. They started paying their dividends in 1944, and their dividend payout ratio is about 71% right now. Their PE ratio is around 30, right around that 30 mark is what I've got. Their sales growth for this year is 10.6%, and their sales growth expected next year is 6.8%.
Okay, so you're staying in the healthcare space. We're starting with Johnson & Johnson, 30 PE ratio, 2.5% dividend, some decent sales growth. Okay, got it. What do you got next?
All right, MCK is next. So McKesson Corporation. So I like the setup here, technically speaking. We got a high base coming again. These guys actually, when they do their high bases, seem to get a little bit of a pop, which is decent here. This one's kind of the newer of the bunch here, really. So we're looking at a price tag around 200, 201 there. Their dividend yield's 8.85%, so not even 1% there. They've got 13 years of consecutive dividend increases. They started paying dividends in 95. Their payout ratio is only 13%. So lots of room there to increase their dividend should they want to do that. Their PE ratio is around 10. That's forward looking. Couldn't find a trailing one on these guys, but their forward looking is about 10.
Current PE ratio is a negative is why. They had the losses over the last year, I think, put them in negative PE. So their forward PE is 10, but I think their current PE is -7.
Yeah, I couldn't even get that -7. I just got NA on the places I looked. So their sales growth currently is 4.8%, and their sales growth next year is expected to be 3.7%.
Mm-hmm.
All right.
What do these guys do, Greg?
They do medical distribution, Greg, but you might not know a little bit more about them.
Yeah, actually, I don't know that much about them. I just knew that they were in the healthcare space. And just I tried to pick three that all fell into that category. So this one here, I actually don't have any more information on that for you.
Pharmaceuticals and medical supplies, Tyler.
Okay. And finally, ABBV. So again, $117 stock, high basing, which all three of these have really kind of been in that space. So looking for breakouts there. At higher levels. So ABBV, 4.5% dividend yield right now. 7 years of consecutive dividend increases. started paying dividends in 2013. Now their payout ratio is 179%. Their PE ratio is around 40. Their current sales growth is 21.9%, and their expected sales growth next year is 6.4%. Now, these guys are actually an offshoot of another company that was formed, I believe, in 2013. That's why you've got the data that you've got. So.
Okay, so we got three here. Let's run them through one real quick time here, Tyler. Then we'll set up the discussion a little bit. Johnson & Johnson's first, traditional play. Everybody knows who Johnson & Johnson is in terms of their products and they put out there. Very, very stable company, long history of paying their dividend, 2.5% dividend up near the high, pushing towards a new breakout. Then you've got McKesson, MCK, and medical distribution company and pharmaceutical and supplies as well. Nice technical trend developing on the daily, pushing towards a new high. They've got a current negative PE ratio. They got a smaller dividend at 1.7%. They do have sales growth year over year for about 5 years in a row. I'm seeing good buyback program actually on their stock as well that it continued in 2021. They got a forward P ratio around 10, but they do have that negative PE ratio. So I'm interested into where everybody's thoughts are on that. Then ABBV, just a beautiful looking trend and chart in my personal opinion. And ABBV, what was the dividend on this one? 4.5%, Greg?
4.49, yep.
So that is the highest in terms of dividend yield, 40 PE ratio, but a really low forward PE ratio. Who wants to go first? I'll go. I think I got a good line on what I want to do here. Give me the daily chart on this one here, Tyler. Not knowing enough about McKesson, I'm going to dump that one first. Give me MCK. When I go into the fundamentals, I look at two different sources while you were just talking here, Greg, and it does have a nice little technical, setup in terms of potential breakout up there at that resistance. I can see it, but that -7 PE ratio just gives me a red flag to where I don't know what happened. Most likely there's an explanation. The last year we had the pandemic. A year ago, they probably went into negative earnings for the first time in a while, all that kind of stuff. But I don't know that yet. So I'm dumping McKesson over the negative PE ratio. Okay. Give me Johnson & Johnson. J&J is just that staple kind of company. I mean, they just knocked down revenue, 82 billion projected in 2021. They got a 30 PE ratio though for a company that's usually going to historically trade a little bit lower than that. So I don't necessarily love it here for a new buy, although the technical breakout is lined up from a short-term perspective. I like J&J as a hold at their 2.5% dividend, mega cap company, $447 billion market cap. I think it's just a nice hold. You've been compensated. You do continue to get compensated. You've had some nice growth in the last year and the 2.5% dividend. I think the buy is probably ABBV, ABBV. And I like the technical consolidation up near the high. Post earnings, we had a nice breakout. It moved into this 10-day tight consolidation. 4.5% dividend does stand out against the other two components. So I'm going ABBV buy, J&J hold, and I'm dumping McKesson. That's my call. Tyler, what about you?
Yeah, I would have dumped McKesson as well. I think this is a tough. This reminds me of Hormel Foods from a price action perspective. A lot of overlapping candles. If I'm going to suffer through that, you got to pay me a pretty good dividend or something. And you're not paying me that great of a dividend. So I'm kind of like, I pick something else. So I'm dumping that for that reason. Chart's a mess. Dividend yield isn't enough to compensate it for me. I think I'll agree with you. J&J, I like holding. Why not? It's a great chart. It's a great stock. The dividend yield's good. I don't mind the higher PE ratio. Everything's high right now in a PE ratio perspective, so that's not an immediate red light for me. And then of the three, I like the ABBV price action the best. The yield's high. It's a high payout ratio, but they could cut it in half, and it's still about as good a yield as Johnson & Johnson. So. And I just like the price action. Their sales growth was the highest as well. Their sales growth projection. So I'm with you. Buy AbbVie, sell McKesson, hold J&J.
Matt?
Yeah, I'm very similar here. I think it's dump MCK, hold Johnson & Johnson. I don't think you're too concerned with the overinflated price there. It's only a 30 PE ratio. That's pretty much undervalued when it comes to the healthcare space in general. And ABBV, I think, is the best technical read here. So it's a swing trade buy for me on ABBV. Johnson's a hold, and the dump is MCK.
So we had a consensus, Greg. Are you going to make it the the 4-man consensus here? What did you think?
Yeah, I pretty much have to, but it's for a little bit different reasons here. So McKesson, they're just not meeting the criteria for me. Their history's not really long enough, to suit me. Johnson and Johnson, obviously a stalwart, 2.5% dividend, 58 years of consecutive dividend increases. I don't get concerned about their longevity at all. Their payout ratio is right in line at 70%, where they can easily continue that dividend for many years to come. Their growth numbers are pretty decent, 10, 11% this year, even 6, 7% next year. So I don't mind those at all. I like the technical pattern, obviously, for a breakout. I'm not playing it as a swing trade, but I do like it if it gets a little bit more of a run as well. Obviously, healthcare has been strong. So I like the space that we're in. The only concern I have about buying ABBV, which is the one I would buy, is that payout ratio is pretty high. Now, the only thing that justifies that is if you look at their current sales growth, their sales growth being what it is, they could cut that payout ratio pretty easily with some decent earnings numbers. So I think that's still in line. That's why I would probably buy that one. So the hold is Johnson and McKesson. Just like I said, it's a higher dollar stock with a really low dividend payment, and it just doesn't have the longevity that I'd like to see. Now, the other part of ABBV that we're not seeing, like I said, is it is an offshoot of another company. So the data that we have is kind of shorter term. But the company that it shot off from was, I believe, it was ABT, if I remember correctly. But the offshoot of it, they used to be a pretty rock solid dividend payer too. So that's why I kind of like that one. Like I said, the only concern about buying ABBV is that payout ratio is a little bit high. But as Tyler pointed out, even if they cut the dividend, which I don't know that they would cut it in half, but even if they did, then you still got a pretty healthy dividend there too. So.